Hey guys, Michael here. So I can buy a more expensive home with less money down, but I have to take longer to pay for it? Is that what's going on? Hey guys, thanks for stopping by the channel. Hit the subscribe button down below so that you can stay up to date on all Barrie and Simcoe County real estate. Hit that like button as well so that other people searching for this type of information, it will be easier for them to find it. So what is going on? Well, starting December 15th, the price cap for insured mortgages is going to raise to $1.5 million, which is up from the $1 million. First-time home buyers will be allowed to take out an insured mortgage with a 30-year amortization, up from the 25 years for all types of homes. And more buyers now are going to be allowed to take out a mortgage of 30 years on pre-construction or new builds. Now that may not account for some investors. So what the rules are, they're aimed at making home buying attainable for more young Canadians. And actually, it's kicked up a lot of interest from a lot of people. But it doesn't start till December 15th, so you can't have a contract done now that takes effect then. All of the deals would have to be done after December the 15th. So what does it do? Does it increase affordability? Well, what young Canadian can afford a mortgage for $1 million or a house in $1 million range? What the bank does usually, so about 25% of what the purchase price is, that's what the bank will lend against. So for an example, you'd need about $250,000 in income to qualify for that mortgage. Not a lot of people out there that would qualify for that. But so now the new limit is $1.5 million up from $1 million. So the reason why that is, that number of $1 million has been in place since 2012. So they've increased it from $1 million to $1.5 million. So that's a 50% increase, which still tames in comparison to house prices, which have went up 70% in that same time period. So getting a mortgage covered by default insurance allows a smaller down payment because lenders, they get compensated if you don't make your payments. So the money goes into a pool, and then if you end up not paying, then they get their money from that. So they're not losing any money ultimately. So as little as 5% down, depending upon the price of the house. So in the more expensive markets like Vancouver and Toronto, what can you buy for $1 million? It's been a steep ask for first-time home buyers to come up with a minimum of 20% down. So that's been the struggle with it. So here's how the pricing house cap is going to change. So if you're buying up to $500,000, you can buy with a minimum of 5% down. From $550,000 and above, so now in this case up to $1.5 million, it's 10%. So the balance is 10%. So overall, if you bought $1.5 million property, your overall down payment would be about 8.33%, which is better than the 20%. So it gives easier access or less down payment for people to be able to purchase homes. So the other thing is the amortization is getting stretched to 30 years. So instead of the standard 25 years. So it's going to take you 5 extra years to pay off your house. So you're both going to have lower mortgage payments, right? So what that does is that improves your ability to qualify. So now you're going to be able to qualify for more of a house because your payments will be less. The challenge you have, or the potential downside to that, is that you overspend or you spend more money than what you should be on the house. You try and buy more home. And then also the stress test that is in effect, that also has something to do with it. And what the stress test is you have to qualify at 5.25% or 2% higher than the rate that you've got, whichever is greater. So what's the downside to all of this? Well, home buyers will be carrying a mortgage payment for a longer period of time. For instance, if you were to buy a house at 35 years of age, and you have a 30-year amortization, you're still going to be paying off your mortgage, or your last payment would be due on the day you retire. So again, you're also probably tempted to spend more money, which probably isn't where you want to go. You're going to be paying interest for a longer period of time. So a smaller portion of your monthly payment is going to go towards principal, whereas more will go towards interest. So also the funny thing is the change in the plans could lend to an uptick in the number of sales. So now all of a sudden more people are interested, so therefore there's more competition, so maybe you pay a little bit more for the house. So it's kind of a double-edged sword. You're going to have to watch where you're going with that. So just to give you a bit of an example, what would happen? So if let's say the average price in Canada right now is about $650,000. So over a 30-year amortization at 4.09% interest rate, your monthly payment would be $2,895 for the first 5-year term of your mortgage. If you had a 25-year amortization, your payment would have been $3,198. So over 5 years, you would have paid $18,172 less in payments than if you had a 25-year amortization. The difference is when your mortgage comes to renew, the mortgage amount that you're going to have is $545,000, which is about $20,000 more than if you would have had a 25-year amortization. So you're paying $18,000 less plus that interest. It makes sense. Comes out to about $20,000. So what does that mean and everything, Mike? Basically, if you've got a 30-year amortization, you're going to make it slightly easier for you to pay for your house, but you're going to pay more money in the long run through interest for the last 5 years. So in short, what does that mean? Well, more people are going to be able to buy houses, and ultimately it's going to cost more money for them overall to own that home. The great news with it is that you're getting into home ownership now. You've got a $650,000 investment as we're using this right here. You're going to continue to pay down your mortgage, and year over year, the value of your property is going to go up. So over time, we hope that that space, ends up at, 100% to be yours, but over time, you're going to gain more and more equity. So is it a good thing? Absolutely. But please, still be careful. Don't get caught into bidding wars. Don't be jumping into things. Go into it with a budget that makes sense for you. Don't overspend. And if you have any questions at all or you want to book an appointment with us, click on the link down below and we'd be more than happy to sit on a call. Any questions, reach out, guys. Enjoy your day.